Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and of course, crystal ball gazing. Today is Tuesday, November 12th, 2024. The only thing worth really mentioning as far as episode highlights is that the CPI is coming out tomorrow on Wednesday. You know, me and the rest of the market is kind of waiting to see what it says. Is inflation higher than what is currently priced in or lower? Currently, year over year, the CPI, I guess, is 2.6% expected. So is it lower? Is it higher? And how will markets react? No changes in the daily reminders. To see me walk through the daily reminders, watch Monday's show. The crystal ball reading remains S&P 500 currently priced like it's a Ponzi scheme, bear market imminent, and the Fed won't cut fast enough to save the economy. Today's chart action, I think, should be taken, again, I say this often, but with a grain of salt, largely because of the CPI coming out and the PPI coming out on Thursday. Markets are in these scenarios where you have it literally the next day. The way I look at everything is that the markets are just preparing for the CPI mostly. So diving straight into the charts, we'll start with the SPX, the S&P 500, closing below the magic 6,000 number today. Notably, we have these two trend lines crossing right at this peak. Amazingly, how we've had this wedge here, and you know, it's obviously acting as some psychological resistance there. When I stare deeply into my crystal ball, I'm starting to see that maybe this could be a top here in the S&P 500, but I've said that many times before in this run up, and I'll say it again. Maybe it'll be right this time. Eventually, I imagine it must be right because of the discrepancies between the valuations and where we are in the business cycle, but we'll see. Again, for my full viewpoints on that, watch Monday's macro show where I go through the daily reminders. TNX, holy moly, threw me off guard, certainly today, with a large pop in the 10-year note yield. Again, this purple line that you see diagonal going across the screen, this represents a very long-term head and shoulders top on, what happened to it? Okay, apparently it was in logarithmic view. So anyway, scrolling out, this purple line represents a long-term head and shoulders top on the 10-year, starting from actually the top in 2021 in yields. Highly psychological little level we have here, shooting, by the way that I have it drawn right now, above the line. And with such a long-term line, it can, you know, there's a certain amount of variability on where that line can be, but yeah, yields shooting higher today in preparation for what I see is like the worst possible news on CPI. It seems like maybe the Treasury market is sniffing out CPI being hotter than what's expected. So in order for yields to keep going higher, well, I imagine that the CPI report will have to come out like very, very, very hot tomorrow. And if it's not very, very, very hot, then we might stabilize around this level or even drop off in yields from this point. I'm not sure. One odd thing to consider is that, you know, when higher inflation is coming in these CPI reports, what it does is it signals to the Fed that they can't do as many cuts as much. And so it will therefore keep rates higher on the short end of the curve. The 10-year being 10 years out, therefore might actually be able to relax a little, assuming that, you know, more disinflation, more powerful disinflation, deflation wave may be coming as a result of that, oddly enough. But we'll see how it plays out. This is like the chart to watch tomorrow. What happens to the 10-year yield note? This is the biggest, most important thing for me. Part of the reason for the importance for myself of this is the fact that I have 55% of my own portfolio exposed to long duration treasury bonds, and its most popular or most liquid fund, TLT, that holds these treasury bonds, is showing a major divergence still between price and the relative strength index. I've been bringing this up on the show, and I'll bring it up again. When we recently had on the daily bar chart a lower high, we had a higher high in the RSI and also a lower low down to the lowest low of TLT in recent time. We actually had a higher low in the RSI, and the RSI is continuing to build strength while the price is not yet showing strength, suggesting that this is set to reverse here. This really could be, with very strong probability, bottom in TLT. Interestingly, for better or for worse, the dollar gaining strength here. For people that are pounding the drum and saying debasement of currency, the dollar is dead. It ain't dead yet. It's actually going up in value right now. And from a technical chart perspective, it looks bullish to me. I've said this on previous shows, and I'll say it again. When you have people using Bollinger Bands and moving averages and gamma flip lines and retracements and all of these, all sorts of fancy things, crossovers, golden crossovers, it all boils down to one very simple concept. The longer something's going up, the more strength it has to just keep going up in that same direction. And same with going down. If it's going down, it's just going down. And then you can see if it starts pausing, going flat like that, well, it might continue higher. If it's been going up, it probably will continue higher. That's the more likely scenario, or that could be the turning point. Why get so much more complicated about this? The dollar is going up. It looks like it's going to keep going up. Here on Robschild gets to vent his frustrations about chartists trying to make it sound more complicated than it really is. Next chart to keep a close eye on is the 10-year break-even inflation rate. Again, with CPI coming out tomorrow, it will tell this market what to do. If it's cool, this should be going down. If it's hot, then maybe we'll be going higher here. Interestingly, we've been going sideways in the 10-year break-even inflation rate since about a month ago. We've been going sideways between a peak of 2.38% and a bottom of 2.27%. So we're preparing for another move here, going sideways like this, either higher or lower. I'm suspecting lower, but I'm just the guy with the crystal ball. Sorry, but not sorry to bring this chart up again. It's just continuing to fascinate me lately, the high yield spread, the junk bond yield spread between junk bonds and treasury bonds, getting just so tight here. 2.63%. People, the credit spread market, I guess we can call it, is just getting, I can only describe it as extremely complacent. There are and will always be periods where stressed debt has to pay a much higher coupon to borrow money, and right now they have to only pay a tiny bit more money, which means investors are trying to they're getting very, very risky here for just a little bit more squeeze of yields here. And that's typically when things can get really dangerous in markets. The markets can get complacent. They think, well, hey, the market, it just keeps going up. It's at an all-time high, so therefore it'll keep going up. And it can. Mr. Market can. But also, like in 2007, when we got to a low of 2.46, right now we're at 2.63. that was the end. And we had the the junk bond spread rise to a rate of 20%. Benjamin Graham discusses this exact thing in his book just constantly, and very wisely says that junk bonds, when they're like this, priced basically at par or near par, they have very low safety to them because you're taking all this risk just for a little bit of extra yield. But when you buy them at a massive discount, like if you were buying junk bonds when there was a 20% spread between them and treasuries, you would have made yourself an extremely safe fortune at that moment. So while others are buying junk bonds like there's no tomorrow, I am actually shorting junk bonds at this moment with put contracts, long-dated put contracts on HYG, a junk bond fund. Next, the Fed funds rate. This is investing.com. Very notably, we've been pricing in very strongly one cut for the December meeting, December 18th. And as of today, we recently dropped the chances of one cut from 66%, so 2/3 chance, to only 59.8% chance of of one cut. And we went, the chance of not cutting at all jumped from only 1/3 to 40%. Just going closer to that 50 mark is a little nerve-wracking for those of us that were thinking that for sure there would be at least one cut in December. The CPI tomorrow may sway these numbers. I just find it very interesting that today, the day before the CPI report comes out, we're going towards 50-50 on the Fed funds rate. So yet another market kind of sniffing out, is the CPI going to be a lot hotter than we expected? Interesting. Another chart that caught my eye today, I called it. I did call this one. I said this is like it's like someone's literally just sitting there with a crayon drawing this chart here with the price of wood. This is one of the most beautiful Head and Shoulders I've ever seen. Just precise, like someone's literally drawing the thing. We cracked the neckline today. So good chartists will want to see a confirmation candle closing beneath the low of today, around 78.70 in wood. And I said that this is one of these leading indicators that may be one of these things that kind of leads all markets downward here. So as far as macro combined with a little bit of chart patterns and a touch of crystal ball gazing, interesting. Next chart, we got two more charts left. MSOS, the cannabis ETF that I mentioned yesterday, and I hinted I might have to nibble on this since it dropped 20% lower than its all-time low. I wasn't going to touch it, but now, when something drops to a low enough price and clearly has value to it of some kind, and people are willing to, people that are selling stock, by the way, at an all-time low are losing money. And when you're purchasing things from them, assuming that there is some kind of future to it and that it is worth more than what they're selling it for, you're gaining what they lost, when you think about it. And you're also, a lot of people think that a low price is not safe. The lower the price, the safer it is, because it has so much more room to go up in price. One thing I wanted to do was check out some of the individual companies. One of the biggest ones is TLRY. How are they doing financially? Is this one of these funds that is holding companies that are holding enormous amounts of debt and just bleeding money and don't have any value, or is there some value to them? So what I'll do is I'll just go to Yahoo Finance, TLRY Brands. This is one of the biggest cannabis companies, and I'll take a look at the balance sheet. Balance sheet right here. We can, for a quick test, I change it to quarterly, so we have a slightly more updated information here. Current assets, this is basically like cash, receivables, and inventory, versus, the current liabilities is 300 million, and they have almost that in cash alone, plus the receivables, so they can survive easily over the next year. And then taking a look at their net PPE, this is the value of all the stuff, the land, the equipment that they have. And good, this is good. I like seeing accumulated depreciation in there. That's priced in. So we have the net PPE being around 572 million. And, even if the machinery, furniture, equipment, even if you cut this all in half, which is what I usually like to do when I'm looking at, well, let's guess this is like 300 million. So 300 million plus the current assets of 700 million, so $1 billion. We'll call it $1 billion of liquidatable assets is what I'll call them, and their total liabilities is 25% lower than that. And so this company is clearly in good financial shape. Yeah, it's been losing money, but it's still also making. Long story short, I nibbled, got into a little bit of this industry. I mean, fear is probably at its highest point for this industry than it will be for a long time. Yeah, and so this is like, for me, this is the best time to take the most advantage of this situation. Again, the people selling shares of this stuff are losing. They're selling at a loss for your gain if you buy. And last chart of the day. You've been watching the show, you know that I own a good deal of this fund, KWEB. It's Chinese internet companies like Amazon, but the Chinese version of Amazon and Facebook and all of their companies, highly undervalued in my opinion. Fair valuation of this specific fund, I'm looking for $45 to $50 range, and I would do a trailing stop loss out of that. When we get to that price, I'm still holding. Yeah, I was hoping that we would break out to the upside from this channel, and we did not. We broke down, and so yeah, this is looking bearish. I'm not sure how low it will go. I don't care too much. I'm in it for an investment, not. I suspect that if the valuation of these companies drops enough, we might get some better news coming out of China as far as stimulus goes to help. But, just zooming out a little bit, the bigger picture is that these are ginormous companies with ginormous amounts of income, stuff, power. These are huge businesses with a heck of a lot more value than they're priced at, no matter how you look at it. And so, again, the cheaper something like this gets, the more exciting it should feel. It's easy to feel good when things are going up and bad when things are going down. It's more correct to feel the opposite, because when things are at all-time highs and just reaching for the skies, that's when they're actually at their most dangerous point, because there's so much to lose. But when prices are low, there's so much to gain. That's when it's time to be excited, when some low, not when it's high. Unless you're a momentum trader, which I'm not yet. I won't. And that's all for me and my crystal ball. Hope you enjoyed. Thank you for watching. See you next time. Rob's Child.